Welcome to Break Away from the Rat Race, a podcast series to awaken your entrepreneurial spirit and help you achieve financial freedom. On our show, you'll learn about investments and how to create passive income. Let's get started with your host, Eric Martel.
Many people ask me, how much profit did you make on this deal or this deal? This is not a bad question, but it doesn't tell the whole story. It would be much better to ask for the return on that particular investment. Welcome back to Break Away from the Rat Race, and today I will talk about returns. And I know a lot of people for some reason get very confused about returns and how to calculate returns, and I'm going to try to simplify that and make it a little bit more intuitive so that you have a feel for what it means instead of just a random calculation. So we're not going to be talking, so profit is really an absolute number, $5,000 or $10,000 profit. Again, doesn't mean a heck of a lot unless you know what you invested or how long it took to get that particular profit. So we're not going to talk about this, but we're going to focus on return. And the return had all kinds of different names. So it could be return on investment, return on equity. It could be return on a cash-on-cash return, sometimes it's called, or IRR. And we'll talk about that. And why we don't talk about the profit is that, let's say you have two opportunities. You have opportunity A, that where you made a profit of $1,000, and opportunity B, where you made a profit of $5,000, so a higher profit. So which investment would you choose between the two? Right? So intuitively you feel that you're missing something. You're missing a part of the picture to make a decision. Sometimes that part of the picture is time. When are you going to get your profit, your $5,000 or your $1,000? But today we're just going to focus on more in terms of the investment. So what is the amount, the initial investment that you have to do in order to achieve this result? So let's say opportunity A, you have to invest $7,000 to get your profit, and opportunity B, the investment for opportunity B is $45,000. Right? Bigger investment, also bigger profit. So again, we look at the numbers, and it's not straightforward. They're not like nice round numbers or anything like that for a purpose to really illustrate the fact that we need to have a way to measure these two, the profitability or the returns on that. And then this is where the returns comes in. This is where that measurement comes in to really identify which one is going to return or is going to be more profitable. And the return is calculated by using the profit divided by the value of the investment. So really it's kind of like the equity or the value of the investment. I'm going to use equity, and then as we go through different example, I'll also go through some other wording that people might use. So return is profit divided by equity. In the case of opportunity A, then I'm looking at profit of $1,000 divided by $7,000, right? So this is where we are on that one. And so the return on that is 14%. If I look at opportunity B, the profit is $5,000 and divided by $45,000. And then the return in that particular example is 11%. So this is the return here. Return 14% for opportunity A and 11% for opportunity B. So even though we have a higher profit, for opportunity B, we have to also put more in terms of investment. So opportunity A would provide a higher return and therefore would be a better investment. And intuitively, that this means 14% means that for every $100 of investment that I do in opportunity A, I'm getting $14 of profit. So this is why opportunity A in this particular case would be a better investment. So this is one example. This is a very basic example of that. Since this investment is a cash investment, so sometimes this would be called a cash-on-cash return. So this is another word for saying the same thing, which is more like a specialized terminology when you're using cash, but really it's the same. Equity is the value of the ownership or the value of your participation in a particular investment vehicle. And so that's where we are. So now this tool, again, very simple, but so we're going to use another example, and we're going to assume that we're going to show you how this tool is going to help you structure a deal to maximize your profit. So let's say you have one opportunity, right? So you have one deal. It's a building. The purchase price for this building is $75K. All right. The rent is $750 a month. So it's a single family home. The operating expenses, I call that OPEX here, is $250 a month, right? So this is the same for, and then we want to figure out how we're going to structure this deal. So option A here would be all cash, right? So we're going to say all cash here, right? So that means that the cash is going to be $75,000. And then when we look at our profit is going to be the rent, minus the operating expenses. So that's going to be 750 minus 250. So we're going to make $500 per month, right? So our return in this particular case is going to be, we want to have our annual return, right? So this would be 500 times 12, so $6,000, divided by our investment, the value of our investment, which is going to be $75,000. So 6,000 divided by $75,000, that gives us about 8% return, right? So this is what we have here. Now we can say, well, maybe we can do better. How about using leverage? So let's look at option B here, which is basically to use leverage. So let's say 80% mortgage that we're going to get on this property. So the cash is going to, in this particular case, is going to be $15K down payment. The rest, the $60K, is a $60K mortgage that's going to be involved in here. So when we look at if we calculate our profit is going to be the rent, again, the operating expenses, and then we're going to have to pay for the mortgage as well, for the financing. Often this is called the debt service as well, but these are all very interchangeable words, right? So rent $750, operating expense the same as what we have before, and now on top of that we're going to have to pay for our mortgage. So instead of 500 profit or net cash flow, we would have $250 a month in net cash flow. So now calculating our return, we say, well, one thing that we have here is that, well, our profit is significantly less, so which is a little bit of a concern. But now what we're going to do is to calculate our return, right? So we're going to say it's 250 times 12, and then we're going to divide that by our cash. And the cash that we invested is $15K. So this is the value of our investment, our parts of our ownership in this particular investment. So $15K is how much we put down here. So the return, and when you do the return on this, it's going to be 20% return. So again, this tool, very simple, and you can see that it really helps you structure the deal to maximize your return on your investment. Intuitively, you can see that I only put $15,000 here. and here's $75,000, right? So yes, my the amount of profit per month is less, but with $75,000, I can get 4 properties that I can leverage, right? So I would be making 4 times on my $250 profit, which is going to be $1,000, obviously higher than my profit here for $500. So it makes sense intuitively that, yeah, you want to use leverage in order to maximize your profit, your return. So so this is something that's obviously, and this is why one of the reasons why we really like real estate is the ability to use leverage to maximize the return. There's a lot of other investments out there that doesn't allow for leverage, and then often this also causes less return. Finally, I'm going to look at another option here. And this is something, if you've watched my videos, the last few videos where I talk about why I sold my house, I know that we live in the San Francisco Bay Area, right? So houses around here, around a lot of the neighborhoods where we are, the value of the house is about $2 million, right? So I'm just going to put, maybe I'll do it like this, $2 million, right? So this is the value of the house. People, again, are kind of focused on the absolute number, because what they do, they look at the rent. They say, well, I can rent my house $6,000. That's $72,000 a year. And that seems like a lot of money, right? And then we look at that and we say, well, I have to pay some taxes, right? So that's like $1,000. And then I have other miscellaneous stuff, let's say $1,000. And then looking at, potential repairs and all of that. So I'm left with $4,000 a month. And it looks like a lot of money. And so that's my profit, right? But when we calculate the return on that, we're saying, well, the profit is $4,000, right? Times 12 is $48,000, divided by $2 million, right? Then my return is about 2%, 2.4% or something like that, right? So it is not a very good return on your equity, right? On the value of your investment in that particular property. So this is why we sold our house. We looked at renting our house and we looked at these numbers, and then I have a 2.4% return. Well, I'd rather get the equity out and then invest in something like we mentioned in here, like option B here, a single family home that generates $250 a month in net cash flow. I can get a lot of these houses at $250 a piece with my $2 million or $1 million equity. And that's at 16 or 20% return on my investment. So this is what I wanted to talk to you about, is really about talking about returns and how to calculate it, how simple it is, but also what a powerful tool it is to evaluate different investments, structure deals differently, and really make better decisions, ask better questions. So with that said, if you have any questions, if you want to contact me, you know where. Otherwise, I'll leave it at that, and have a good day. Take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.